Good afternoon, everyone. Thank you so much for joining Curo's Investment Committee today for our second quarter market review and update. I am Atrisa Roberts. I am COO and partner here at Kestra Private Wealth. I am joined by my lovely partner, Ann McCabe, who is CEO here with us. We also have joining us Xander Cochran or Alexander Cochran, our investment and planning associate. And then our financial advisor, Manny Carranza, who works with many of you out of our Rockville office. So we're excited to have you join today, and hopefully you find the material both insightful and informative. So if we are ready, we will go ahead and get started. We want to make the most efficient use of your time today. Okay, so we will begin this market update and review as we do with each of them. And that is with a quick review of 2025 so far. So this year, as many of you I'm sure are aware, has been filled with some economic headwinds. Primarily, these include the high tariff uncertainty, the government layoffs, geopolitical tensions, low consumer confidence despite a roaring market, and slowing economic data. For the first quarter of this year, we did see a slight contraction in GDP of about a negative 0.5%. But after a very steep 19% decline in the first weeks of April, so almost near correction territory, the S&P 500 has had one of its strongest market rallies in 75 years, which is crazy to even think about. And the US markets are hitting all-time highs as they seem to be shrugging off a lot of the elevated trade and policy uncertainty. So it's the market that continues to surprise, I think, at least this committee. So we'll go into a little more detail about the market sectors in specificity. So US markets now, even after that deep correction of April, are up in positive territory, up about 6%. But these are, of course, being eclipsed by both emerging markets and ex-US developed international markets, which are both up double digits. Now, the performance of the S&P, or what we think of as the US market, has been impacted by some of the what was previous strong Magnificent Seven performers struggling so far this year, with Tesla down about 18% and Apple down about 14%. But bonds have held up well, with all in positive territory, with the exceptions of municipals, which have been mostly flat. And then commodities have seen positive year-to-date returns, but we've seen a slowing US real estate market down just over 1%. So we'll go into a little bit deeper as we talk about that correction. So as you may remember, in the first weeks of April, as the president announced, I think he called it Liberation Day, the markets began to sell off very dramatically after a strong start to the year, and by April 8th, hit a low in the S&P 500. But as you can see in the chart that we're showing here, is that it's been what we call a V-shaped correction, or a very steep rally or a deep rally out of what was the bottom of the market. So this bounce back has been notably fast, ranking as the second fastest rebound from a drawdown of at least 19% in the last 17 years. So if we take a look back historically at some of our strongest 50-day rallies in US history, we tend to see continued rally after those strongest 50 days. So our current rally, at least from April 8th going through June 20th, ranks about 9th or 10th in all-time 50-day strongest rallies. And historically, these types of rallies are followed by impressive gains over the next 3, 6, and even 12 months. So specifically after the previous 10 strongest rallies, the S&P delivered average returns of 6.4% in the subsequent 3 months, 10.5% in the subsequent 6 months, and 16.4% in the subsequent 12 months. Now, it is crucial to remember that past performance is not a guarantee of future results. There have been instances where we've seen subsequent negative returns after a strongest 50-day rally. So now I'm going to turn it over to my colleague Manny, who will talk a little bit more about the S&P.
Thanks, Atrisa. So this slide shows where the S&P 500's forward price to earnings ratio stands today compared to its 30-year average. So in the middle, there's a horizontal line running across the chart, and that marks the long-term average, which sits at 17 times. The forward PE ratio tells us how much investors are willing to pay for each dollar of a company's expected earnings over the next 12 months. So a higher PE usually means investors expect strong future growth or that stocks are simply becoming more expensive relative to their earnings outlook. As of July 25th, the S&P 500's forward PE is 22.5 times, which is 5.5 points above the 30-year average. To put that into context, the last time we saw valuation at this level was around the dot-com bubble. So this slide also includes Shiller's PE ratio, or CAPE, which looks at the average inflation adjusted earnings over the past 10 years. This metric is useful for smoothing out short-term fluctuations and giving us a longer-term valuation perspective. So as of July 25th, Shiller's PE stood at 38.6 times, a level that historically has signaled an overvalued market. Together, these metrics suggest that U.S. equities, specifically the S&P 500, are trading at elevated valuations by historical standards. So this next slide here, this chart compares the performance of the S&P 500 versus international stocks, which are represented by the MSCI World ex-US Index, and it's from a time period of January through June of 2025. As you can see, both markets started the year with similar momentum, tracking closely through January, but beginning in February, international equities began to pull ahead, and they've continued to outperform U.S. stocks through the end of the second quarter. This trend sets the stage for a deeper conversation around valuation, opportunity, and the role of global diversification, which we'll explore on the next slide. So this chart here shows the valuation gap between international stocks and U.S. stocks using that forward price to earnings ratio. Historically, international stocks have traded at a discount on average of about 2.9 times lower than U.S. stocks. As of the end of June, that discount has widened significantly to 7.9 times, which is well below the long-term average. And that's notable. And what's notable is that this comes despite international stocks outperforming the US market in the first half of 2025, which we saw in the last slide. So in other words, even after a stretch of stronger returns, international equities are still trading at a deep relative discount. So this is a powerful reminder of the importance of geographic diversification. Not only does it help reduce concentration risk in any one market, but it can also open the door to opportunities where valuations may be more compelling, especially when investor sentiment hasn't yet caught up with recent performance. Some of the changes we've been making recently in our portfolios is we've reduced our tilt to defensive sectors. When reviewing our models, we saw that our largest defensive sector was the healthcare sector. We had a 2% healthcare position, so we sold this and used the proceeds to add to quality and large cap growth stocks. Making this change brings the portfolio closer to neutral on value versus growth and reduces the defensive tilt while still maintaining an overweight to healthcare, which we believe provides an opportunity for growth looking forward. So next, we have my colleague Xander.
All right, thanks. So we're gonna next look at the economic picture right now. And we like to start off with looking at our economic dashboard, which we look at every quarter. And if you followed along with us in the past, you may notice that the economic dashboard for this quarter looks quite similar to past quarters, with the only exception of the change in the past quarter has been for housing. Previously, it had been on the line between the gray and red section, but it's moved slightly into the red section. So for a recap of the economic dashboard, again, this shows 5 different aspects of the economy from a positive to negative territory and where they currently stand. And so right now for monetary policy, which is largely what the Federal Reserve Bank is doing with interest rates, it is actually Fed Day today, which means the Federal Reserve is having their press conference and releasing the news on interest rates. Most likely they will not cut today, but we'll see that very shortly this afternoon. But likely they are going to wait a little bit longer. They've been hesitant to cut rates this year because of the impact of tariffs and how that could affect inflation. And so right now we expect there could be, or the market expects there could be 1 to 2 cuts in the back half of this year, potentially starting as soon as September or possibly in December. Next, we have manufacturing, which has struggled a little bit in the past few years. It's been a little bit more into the negative side of neutral. We've had some months where it looks a little bit more towards expansionary territory, but lately it's been struggling a little bit. The consumer is also in the neutral territory, but a little bit more towards the positive side, as the consumer balance sheet remains relatively healthy, although we have seen some delinquencies increasing and consumer confidence, although it increased in the past month, is still very low compared to historical records. So consumers definitely still don't feel so great about the economy, despite the economy still doing pretty well. Next, we have housing, which I mentioned is now into negative territory. So we have seen continuing that housing costs and borrowing rates or mortgages have remained high. And it had been a little bit more of a seller's market, but now that we're seeing an increase in inventory overall for the housing market, and we're also seeing some listing prices decrease or prices overall coming down a little bit, depending on what markets the house is in. And so it's not really a seller's market, it's not really a buyer's market either because of that. And so we're kind of stuck in neutral beyond neutral and negative territory right now because of that. And then lastly, we have the labor market, which is in neutral territory as well, but a little bit more towards the positive. We have seen a slowing of the labor market a bit, but the unemployment rate has stayed quite steady over the past several months, around 4.1 to 4.2%. And despite the labor market slowing a bit, it's still relatively healthy. And as people are employed, they're going out and spending their money, and that's helping keep the economy afloat. Now, for the next slide, we have a little bit more into what the economy is looking at. And so as Teresa mentioned, towards the beginning, for the first quarter, we did see a contraction in GDP of 0.5%. And we also did just get brand new, fresh off the press numbers today for Q2 coming in at 3%, which is stronger than expected. But this here is looking at what's called core GDP, or really it's real final sales to private domestic purchasers. And what this does is it strips out the volatile components of inventory and trade along with government spending. And inventory and trade has really been what has caused those fluctuations. So if you strip that out, you can see that for Q1, it came in at 1.9%, which is much stronger than the negative overall GDP number, although it definitely was a slowing. And so if you take out some of the effects from tariffs that have been going on, it shows the picture of the economy overall. While it has slowed, it isn't negative. And now that we have the Q2 number, it does show that earlier, many economists were fearful of a recession possibly happening on the back of the reciprocal tariff announcement, but that seems to be a little bit less likely now. In the next slide, we have a picture of the labor market, and we definitely see here over the past several quarters a slowing in the labor market. And then in the dark red color, we see what is the Bloomberg consensus of economists right now. And we can see here in the back half of this year, economists are expecting right now job growth numbers of less than 100,000 jobs per month on the payroll. However, we also see a slower population growth in the US right now due to immigration policy. And so while we see a slowing labor market, we also see slowing population. And so as long as there's not a major shock to this labor market, it seems like the economy and the labor market can withstand those slower numbers without it being too negative. But we definitely have seen a downshift in the labor market of late. And then next, we have a picture of inflation. And particularly, we've seen a reacceleration in the month of June. So for March through May, we had some pretty low inflation numbers for headline CPI. We did see a tick up to 2.7% for inflation for the month of June. And more notably, you can see here, this chart breaks down by different aspects or contributors to inflation. And the orange, which is core goods, we finally see that back into positive territory due to the tariff impacts. And so for part of 2024, it had actually been negative. So there had been some disinflation or roughly neutral, but now it's into positive or contributing to inflation right now. And it did take a few months for that to kind of impact as tariffs have taken a little bit longer to impact prices, but we are starting to see that. And the big question is, how much does that continue to affect prices increasing? Also, how much does it affect corporate profits as well? And although we have a better picture now of what tariffs could look like, we still don't know the final impact and how long it takes before it really takes its full effect. And lastly, I'm going to finish up my slides with a picture of tariffs. So this slide here is showing on the left side a picture of the average tariff rate collected going all the way back to 1900. And so in the early 1900s, we saw high elevated tariff rates. And then over time, it got much smaller into single digit percentage. Then on the right side of the chart here, you see a zoomed in picture of this year since the new administration. And tariff rates have definitely moved up, although they've moved around pretty significantly as the tariff policy changed at almost day-to-day basis, it seems like. Right now, the estimate as of mid-July is around 17% for the average effective tariff rate. And on August 1st, we're expected to get more final numbers after the 90-day reciprocal tariff pause is gone away with. There's still questions about what China will be. That comes out later in August. But at least we'd have a little bit clearer picture of what tariffs could look like. But again, what we don't know is the final impact of how much it could affect the economy in terms of corporate earnings. That may come down. We've already seen some manufacturers note that earnings are coming down because of tariffs. And then as well as the inflation picture, how much does it really come down to the final consumer in terms of affecting prices there as well. And with that, I'll turn it over to Anne.
All right, thanks, Sander. So I get to talk about artificial intelligence, which if you listen to our podcast, you know that is Atrisa's favorite topic. So I don't know how I got this chart, but you can't really go anywhere without hearing all about AI. And arguably, AI and the focus on AI is one of the big reasons that we have not seen a recession this year and that we have seen the market really on a tear, as Atrisa showed with that V-shaped recovery. So in this chart, we are showing two sides of the AI coin. On the left-hand side, we're looking at capital spending on AI by 4 of the major AI hyperscalers. So these are all companies you are familiar with. And if you draw your attention to 2024, you'll see just a massive explosion in spending just amongst these 4 companies, almost to the tune of $200 billion in capital spending. And most of this capital spending is actually coming from existing cash flows and cash reserves. Now, if we look at the right-hand side of the chart, this really aims to look at the adoption of AI. So we know there's a lot of excitement around AI. There's clearly a lot of investment and a lot of spending. But the big question is, how effective is AI going to be at increasing productivity and efficiency, which is really the promise that AI makes? So on the right-hand side of the chart, what we're looking at is the current percentage of corporate America that is actively using AI applications and technology. So you'll see that currently it's sitting at about 9%, with another 12 to 13% expected to implement over the next 6 months. And not surprisingly, we're seeing information technology really lead the way in terms of adoption, but we're also seeing some adoption across some of the other sectors of the economy as well. So a couple of things to kind of take away from this chart is really, number one, AI is a very large focus of the markets and of the economy. And we're also relatively early to the AI adoption game. If you think about just 9% of corporate America really already having used and adopted AI. And I will let you know that here at Curo, we are actually testing some AI tools around note-taking and other tools that can possibly help us with efficiency and productivity. So the I guess end product of all of this is still to be determined, but there is no doubt that there's a lot of excitement and a lot of focus on AI and investment there. So if you are just joining us for the first webinar ever, this will be a new chart to you, but those of you who have been around for a while, this is a chart that we always like to end our webinars with. And this is taking a very long-term look at stocks as well as a few other asset classes, over 200 years worth of data, actually. And what you will see here is historically, stocks have been the best place to build wealth over time. And although in any short period of time, like what we experienced back in April of this year, stocks can be extremely volatile, we would argue that over the long run, when you are able to zoom out quite a bit, they are actually less volatile and build more wealth than a lot of the other asset classes that you see on this chart. So the other thing we love to finish up with is this visual of our process and our philosophy here at Curo. And what we try to do each and every day when we're working with you all, our clients, is to live where the two concentric circles come together, what matters in your lives and what we can control. But actually, just to switch it up a little bit for this webinar, we're going to talk a little bit about something that we can't control down in that can't control circle, and that is congressional policy and tax/retirement changes. And so we do have one final slide to go over with you that highlights recent changes from the One Big Beautiful Bill Act. That's the only time I'm going to say that. I'm going to call it OBA from now on because it's just a mouthful. But as you all are aware, President Trump did sign OBA back on July 4th, so it is official. And what we are attempting to do in this slide is take about 870 pages worth of legislation and summarize it in one slide. So we have clearly just pulled out the highlights of the aspects that we think impact the majority of people, but there is so much more to talk about here. So we are really just keeping it to the highlights, which I will briefly go through. So first and foremost, the tax brackets that were introduced back in 2017 with the Tax Cuts and Jobs Act when President Trump was in his first administration, those are now permanent. Now, when we say permanent, take that with a grain of salt, because that really just means until we get a new administration / a new Congress and they decide to change tax laws again. So we're calling it permanent-ish. But those new tax brackets, or existing tax brackets rather, are now permanent. And it does keep the top tax rate at 37%, down from over 39%. And then standard deductions are also locked in, quote unquote, permanent, as well as expanded. So those numbers did go up beginning this year in 2025. We also saw a new, what we're calling a boosted deduction for seniors. So for taxpayers over the age of 65, they can now deduct an extra $6,000 per person. So if you are part of a couple, married filing jointly, and you are both over 65, that amount is $12,000. Now, this is subject to income limits, and this is also temporary. So this will expire in 2028. And this provision was really a campaign promise that President Trump made. If you remember him talking about not taxing Social Security, Social Security is still taxable, but this deduction is an attempt to try to fulfill that campaign promise. It's also why it expires in 2028. But be very careful about those income limits because they do phase that deduction down to zero. The next big change was the SALT deduction that got a lot of focus and attention. And that cap increased from $10,000 all the way up to $40,000, quite a large increase. Beginning in 2025, that also phases out. So keep that in mind. And it will revert back to $10,000 beginning in 2030. We did see a nice increase in the estate tax exemption. So this year, the exemption's about 13.9 million. We will see that increase to 15 million starting next year and will be quote unquote permanent. 15 million per person, $30 million for couples. So the vast majority of Americans will not have an estate tax problem moving forward with those numbers. We did see the child tax credit increase, and then we are also seeing the clean vehicle credit expire on September 30th, despite Elon Musk's very strong attempts to get that to be taken out of the tax bill. It was not, it was included. And there is so much more. So Teresa and I have now recorded 2 different podcasts going through OBA. One was released this past Tuesday, which was yesterday, and the next one will be released next Tuesday. So feel free to check out episode 65 and 66 for more information on OBA. And with that, we would be happy to answer any questions that anyone has. So if you have any questions, feel free to pop those in the Q&A box, and we will answer those for you.
And of course, if following this webinar, something pops up that you didn't have an opportunity to ask, feel free, of course, to reach out to either of us directly, but you can also send an email to info@curoprivatewealth.com, and we'll be happy to address those follow-up questions there. And then just as a note, before we wrap up, don't forget to connect with us on our social media platforms, and already mentioned the Living Richly with Curo podcast, which is available on all podcast sites, including YouTube. And then you can also find us on LinkedIn and Facebook. So with that, I will check the Q&A and see if anything has come through. And we have no questions yet so far. So I think that means we've done a wonderful job giving a second quarter update. But we will allow, of course, a few more moments. In case any of you have any questions, please feel free to drop them in the chat. We'd be more than happy to address those before you leave today.
Yeah, Xander, I have a question for you. Since I know that any Fed Day, we know that Xander will be tuning in to
Yes.
Powell and listening and then sharing his notes with the rest of the team, which we very much appreciate. What do you expect Powell to say today? You know, obviously there's been a lot of focus on Trump and Powell and that weird dynamic that we're seeing, but what do you expect him to say, just sort of in the uncomfortable situation that he's in?
Yeah, I mean, I think he's probably going to say similar things to what he said in the past couple of press conferences when he got asked that, which was not much. When it came to if Trump could fire him, he basically said, nope, you can't do that under the law. He's going to continue to say that the Fed approaches it from an apolitical position. They try to leave the politics out of it as much as possible. And so any political pressure, I think, is going to be diffused as much as possible in his answering of the questions. So I would assume he's probably going to get asked that. He's probably not going to say too much about that, but I am interested to see if he does comment, given the interview that was with both of them side by side, and see if there's any comment from that, which would be interesting to see. But yeah, I would say overall for the Fed, the other thing that I'll be looking out for is if there's any kind of positioning for a possible rate cut in September, because that would be the earliest that we'd really see it. The other thing that we could see in terms of the votes, there could be a couple dissents. We've seen a dissent or so happen in the past, but the last time that there have been multiple dissents within one meeting has been, I think, since 1993 was the last time. Don't quote me on that. But basically showing a little bit more of a bifurcation in the view of different members within the Fed. And I think it's also important to remember it's not just Jerome Powell making the vote, it's a vote of 12 people on the Fed board making that vote possible for what happens with interest rates.
Yeah, it'll be interesting to see if Powell gives a little zinger on the tariffs and the, you know, the slight uptick we saw in inflation, that he throws that dagger. We'll see.
I'd be shocked if he held back with that one.
I know. It's just too easy. I mean, if I were him, I totally would.
Yeah, the other thing I'll
right.
just kind of pose to us before we wrap up, because I've had some clients sort of one-on-one ask, and it's just about our general outlook about going forward. I mean, of course, we highlighted the slide showing what subsequent S&P 500 returns look like following a 50-day strong rally. But I think maybe just our feeling of things going forward is probably helpful to share. But I'll start. And again, for our clients who are still here on the call with us, our investment committee meets at least once a month. So at least once a month, we're getting together, having conversations, looking at what's happening in the market and economic cycle, and making the most informed decisions we can with the information that we have. And I think generally, and please feel free to chime in, investment committee, I think we have slowly gotten a little more cautious as the year progressed. I think we all started out maybe a little bit more bullish and optimistic in January. But again, it continues to be a market that surprises. It kind of shrugs off any what we think would be bad news or volatile news and just kind of keeps roaring. So I think I made a comment to Xander a couple of weeks ago, like I'm just waiting for the other shoe to drop, right? It's like that feeling like you're waiting for this stuff to kind of get baked in. And I think Xander said, okay, well, we'll see next week with the tariffs, like what happens. And then the market shrugs it off and we just keep going up. So any other comments you guys want to add just about general outlook might be helpful for our audience today as well.
Yeah, I'll share. I think cautiously optimistic, as much as I feel like I've overused that phrase over the course of my career many times. I'm cautiously optimistic, but one of the things that I think we definitely have to see shake out is the actual impact of the tariffs, because I think we've all agreed that even though worst case scenario is no longer on the table, thankfully, the zero is also not on the table, or going back to the average rates that we saw prior to President Trump taking office this year are not coming back. And so we believe that the impact is probably going to be shared between corporations, which means potentially lower corporate profits, and the consumer, which means just less dollars for them to spend elsewhere. And so, you know, we don't really see how this doesn't have a negative impact on the markets and on the economy. And with valuations back up to pretty high levels, as Manny shared with us, you know, I do think that even though we haven't seen a big sell-off or freak out in the last, you know, couple of months, I think we're, you know, potentially ripe for more volatility because we're just in a sensitive position. But AI is very much one of the big reasons that we're seeing the market, you know, continue to go up. I think back in, you know, 2024, the US consumer was the reason that we didn't have a recession. And I think AI is that reason now. I don't think it's the US consumer anymore. I think it's, you know, very much the excitement around AI.
And just a note, Anne mentioned that it's my favorite topic. That was, of course, a very sarcastic
I was being
comment.
facetious.
She's being facetious. I'm terrified.
Manny or Xander, do y'all have anything to add on kind of the overall feeling?
Yeah, the only thing I'd add is that another thing I'm looking forward to seeing is what the impact of the layoffs have coming into the fall. Just because, like Xander said, the anticipated job openings are expected to continue to decrease. So just seeing how difficult that labor market is at the time, I think that'll be telling, or maybe that'll wake investors up to, I guess, to realize all the concerns that we're actually seeing right now. But also optimistic because of the consumer and AI. But yeah, I'm waiting for September.
Yeah, and I would just add, I think growth now looks slowed, but still could be good. But markets right now are definitely more fragile. And so it doesn't take much of bad news because there's so much bad news already, or less good news already baked in, and markets are at higher valuations, that it could just take a little bit more to tip the scale of bad news before we see another bout of volatility. I don't know if we're going to get something of what we saw in April again, but I think that's kind of why we're more neutral right now in how we're positioning portfolios. We've struggled maybe a little bit, or had some back and forth, just talking about how defensive do we want to get? Do we want to make sure we're defensive enough that if we see volatility increase, that's good for portfolios, but also we don't want to give up too much on the upside as well. So that was part of the conversation that we had leading up to the recent changes that we had, that Manny talked about, reducing the defensiveness slightly, getting a little bit more towards quality and growth in the portfolio, but right now still very neutral in terms of a stock to bond balance within portfolios.
Yeah, that's a great point. It's a delicate line that I think we're walking as an IC, where you want to be positioned defensively for that fragile market, but you can't also stomach losing what the market has been doing to the upside all year. So we've definitely been doing that dance for the last several meetings about what makes sense in client portfolios.
Yeah,
Well,
the other thing I'll
okay,
add, sorry, one more thing. The other thing I'll add that we've talked about a lot in the past is we are very proactive cash managers. So for our clients who are in the distribution phase, that means you are taking money out of your portfolio in the form of income. We have taken this recovery as an opportunity to raise more cash and stick more cash on the sidelines for you that's protected, whether that's in a high yield money market or maybe even a conservative short-term bond fund that we're getting a little bit higher interest on, just because if and when we do see the market sell off again, we don't want to have to sell investments to generate that cash for you when the market is down. So just know too, behind the scenes, that we are being very proactive about taking advantage of the market rally. And that's really important because we never want to be in a position where we have to sell investments when the market is down. We know that the market always comes back up when it's down. We just can't tell you exactly when that time period is going to be. And so we need to make sure we have plenty of cash sitting on the sidelines so that your income is not impacted. So I also wanted to mention that's a very proactive and tactical thing that we're doing behind the scenes.
Yeah. And the Fed's hesitation to cut interest rates have made the money market yields still very attractive this year.
Very attractive.
Which has been helpful.
Exactly.
Which has been helpful.
Yeah.
All righty. Well, I don't see any open questions. Again, if there's something that you think of that you would like the committee to address, please do not hesitate to reach out to us. Of course, you can email any of us individually or send an email to info@curoprivatewealth.com. Also, as a reminder, for more detailed information on the OBA, you can also listen to episode 65 and then the coming episode next Tuesday, 66, where Ann and I discuss it in more detail on the Living Richly with Curo podcast. So on behalf of, oh, please, Anne.
There is also, I lied, one more thing. There is also a survey that's going to pop up right when we finalize the webinar, when we finish the webinar. So if you don't mind, literally 2 minutes, we would love your feedback. This is for you all. I mean, we talk about this stuff each and every day, but we're putting this on for you. So we'd love to hear your feedback. What did you like? What could we do better? What should we talk about in the future? Any tweaks that you all would recommend? We would love to hear from you. So if you don't mind spending 2 more minutes giving us that feedback, we would really appreciate it. Now I'm done, for real.
Okay, for real. Okay, so
I do see we got one question come in.
Oh dear.
the 11th hour. Okay, so let's see. Comparing your slides on U.S. stock performance projections. Oh, sorry, U.S. stock performance projections on U.S. stock trends and non-U.S. based stock performance. It would seem that it may be a good time to move from U.S. based to overseas investments. Can you please comment on that? Don't all rush in.
Yes, the answer is yes.
Yes.
We have done some of that. Go ahead,
Yes.
Xander.
Yeah, I was going to say now's a good time, but a few months ago would have been a better time. And that's actually when we did that. So we had been a little bit underweight international or non-US stocks versus US. And we bumped that up a few months back because we were seeing that trend already take hold. And so we increased our allocation overall to international stock as we're seeing that they were doing better in terms of the news coming out about tariffs. So we did increase that. We continue to see that as a good opportunity within portfolios. And so right now we have a roughly neutral versus our benchmark when it comes to US versus non-US stocks. And that's an ongoing conversation. If we want to go a little bit more overweight, that's definitely a possibility that we could continue to do in the future. But the other thing to note is compared to a lot of US-based investors, US-based investors tend to have a home bias. And so typically, if you see a kind of meta-analysis of portfolios from JP Morgan, they're going to have about 22% roughly in international stocks of the stock exposure within the portfolio. Compare that to our portfolios, we're higher at about 30% right now. So we're already, although we're neutral compared to our benchmark, compared to the average US investor, we're actually significantly more exposed to international stocks right now. So hopefully
Great
that
question.
answers
Thank
your
you
question.
Yeah, thank you for that
Yeah,
question.
thank you for the question. Unaware.
All right, going once. All right, again, the webinar has been recorded, and in the next week or so, we will have the final version of this recording ready to share. It can go out, and of course, this live webinar is for Curo clients only, but with the recording, please feel free to share with family, friends, colleagues who you think may benefit from the content. And again, if there's anything that we can do to better support you, please do not hesitate to reach out. We so sincerely appreciate your trust in us, your continued partnership. We value this relationship very much, and we hope that this has been insightful and helpful for you. So until the next quarter, have a beautiful rest of the summer, and we'll look forward to seeing most of you in the fall. Have a good one.
Bye.
Thanks, everyone.